What's going on, guys? Hope you're having an absolutely fantastic day. So today we need to talk about this rate hike cycle statistics, right? So basically in the past recent weeks and months, since the Fed has been a topic again, we have seen that there's a lot of these charts coming out, right? So I just want to take the data and backtest it and take a look at what conclusions we can draw, right? So I'm specifically looking at the 1999 to 2000 cycle, the 2004 to 2006 cycle, and the 2015 to 2018 cycle, right? So if you take a look, I've already highlighted it. So if you take a look, you can see that, let me put this in full screen. You can see I basically 6 months ahead of time, ahead of the first rate hike, I have highlighted it. And then this is a rate hike cycle. And then this is after the rate hike cycle, right? So we can see that the 6 months ahead, so good performance, 11%, almost 12%. And then during the rate hike, another 10%, right? But I think what the data fails to capture here is obviously the last one, right? And fails to capture the first 6 months as well, right? They only give you the very clear cut just during the rate hike cycle, right? And we can see what happened after the rate hike cycle, right? So I'm not even taking the top here. Basically, I'm just taking after the rate hike cycle finish the next month, right? So what happens after the next month? From peak to bottom, basically you can lose 50% of your money. Right? So we all know this happened because this is during the dot-com bubble. And basically, these rate hikes, right? I read a very interesting Seeking Alpha article yesterday, which is basically saying that if you just look at all this data, obviously you get the wrong picture. Because during the rate hike, and the reason they stop hiking the rates, right, is because they break something or there's a bust, right? So you can see that from the even the peak to the bottom, it's even more, right? But I didn't measure the peak, right? I just took the basically from the end of the rate hike cycle until what's happening here, right? So you can see that if you take from 6 months behind, because why am I taking 6 months ahead or 6 months kind of data, right? It's because the markets are always pricing in 6 months ahead, right? So you can see that this during the before the hike, basically there's a 6 months basically pricing period, right? As we can see during this time, there's in 2022 there's a lot of sell-off happening before the rate hike, right? Obviously there's more factors like war or everything, but primarily speaking that markets are always looking 6 months ahead, right? So you can see that they don't show you this data, right? This first data and also this second data. So you can see the this data point, and my data might be a bit different from this picture because I'm using a monthly chart, right? Because if I use weekly, it's basically too many candles, right? And you can see that, yeah, it's up 10% during the rate hike cycle. So what does that mean for us, right? So let's take a look at the second one and then the third one, and then we'll decide. Right? So you can see that 6 months in 2004 to 2006, basically you lost 7%, and then during the hiking cycle, basically you gain another 20%. So bear in mind that these are all bubble-like movements, right? Because we can see that after this hikes, basically something broke and then the bubble burst, right? So we can see this one after the hike, there's still another period of the market continue to run, and then from this part, which is also not shown in the statistics, you lose 57%, right? And the global financial system almost melt down, right? So if you do enjoy the video up to this point, do help me smash up the like button, hit subscribe, and also hit the bell button, because these videos do really take some time to make, right? So let's take a look at the last one. So the 6 months moving ahead, you lost about 6.9%, and then during the hiking cycle, you gain about 25%. And after the hiking cycle, so this is from 2018 to 2020, where there's a outbreak of this virus. So I'm not sure whether this data is really applicable because this is like a black swan event, right? So now we take a look at 2022. So where we are. So sorry, where are we? So I believe we're in this phase where we lose about 6 to 7%. So you can see the first scenario may have been an outlier because it's a gain of 12%, right? While the others are loss of 7%, loss of 7%. This is a loss of 10%, right? So this is basically the past 6 months up to today, right? So basically, so maybe what they are saying might be correct. That during this rate cycle, we'll gain a lot of percentages on the market. But I just want to say this, and I really hate saying this, but this time actually might be different, right? Because what you can see what's happening during the 2018 hike which is that they have low inflation, and also they are hiking because the market, basically the labor market and all that, is already very strong, right? And you can see that in this part is very similar, right? So from 2004 to 2006, obviously economic activity was booming, right? The housing market, everyone was getting a home, right? And then you can see during the dot-com bubble, obviously during this time, a lot of jobs were created in the tech industry. So I don't know what they were doing over there, but it didn't create any shareholder value, but it created a lot of jobs, right? And a lot of positions to be filled, and them making a lot of big bucks, right? So we can see this time is actually different. Why? Because this is the first time we've had inflation in a long time, right? So if we take a look at this, so I don't think the data will exactly follow this, like this plus 24%, right? If anyone is hoping for that. There's a statement from Warren Buffett, which is most people would rather die than think. And this is very true for this time, right? A lot of people will just look at these statistics or look at this statistic and say that, oh, the rate hike cycle is good for stocks. But what the rate hike cycle fails to account for is this losses after that, right? So if you're saying you're a trader, then yeah, maybe this statistics is useful for you. But if you're a long-term investor, look at this. And also I would want to say separate the market from stocks, right? Because individual stocks can perform really well even though the market is going down, right? But usually what happens is when markets go down, the stocks go down as well, right? So that's kind of a conflicting statement, but if you take a look at some stocks that are performing very well, right? Doesn't matter when it is, right? Look at Tesla or whatever it is. So it doesn't matter when it is. Even the stock market is not doing well, the stock can be doing extremely well as well. So what do I think will happen next? Basically, I think we are already moving past this stage because we've already moved into the first hike cycle, right? So if history is to tell us anything, we can expect some positive returns in the next few months, right? But in my opinion, I would think there's too much uncertainty, and taking a bit of the medium-term view, right? In 1 to 2 years, I do not see us making gains, right? From this point until 1 to 2 years from now. I believe the upside is very limited while the downside is really there, right? So I believe either we will stay flat or we'll go down in 1 to 2 years, right? So, because obviously I do believe the US is looking likely to enter a recession. So there's 10-2 spreads and all happening, and that really highlights like the chance for recession and all. So I'm not going to talk about that in this video, but I do believe that the US is heading into a recession, right? So obviously, so what can we make of this, right? So, in my opinion, it's time to start researching like things that you really want to buy, right? So when this thing happens, right, you're already ready, right? So when this thing happens, you're already ready, right? So there is no point saying that, oh, if this stock is not at the price that I'm willing to buy today, then I shouldn't follow it. So you need to follow these stocks and build your conviction, right? And then when you're ready to pull the trigger, basically you can pull the trigger very heavily, right? Because you can see that these opportunities don't last for a long time, right? So if you can see the bottom, it only lasts for 1 to 2 months, right? So you have to really take action. So do I believe we're at the bottom? Personally, me, I don't believe we're at the bottom because this excessive runs have been really, crazy. So it might take us a few years to calm down and basically reset everything, get all the froth out of the market, right? So yeah, that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. And with that being said, have a fantastic day and peace out.